So today we're going to talk about investment accounts, namely like an IRA, so the traditional IRA, the Roth IRA, and the brokerage account, how those work and why they're different accounts. We're not going to talk about the markets because it's still doing what it's doing, which is having volatile movements. So, and again, that's nothing new, so it's fine. Just don't panic. So that's all we're going to talk about on that today. So let's talk about the three different investment accounts. And the reason I'm focusing on these three is because if you understand how traditional and Roth IRA and brokerage accounts work, then, well, really that traditional IRA and the Roth IRA, if you understand how those work, you'll also understand how your 401ks will work, whether they're also traditional or Roth 401ks. Now, and I'll get into that a little bit later as to how you find that out. So, all right, so let's talk about first brokerage. So you notice I've got my glasses because I'm tired today. It has been a long day. Anyways, okay, so brokerage accounts. So those ones, you have to go through a brokerage firm in order to open. You can't open them at a bank, credit union. You have to go through a broker-dealer. So that would be a company like Fidelity, E-Trade, Charles Schwab, TD Ameritrade. Any of those companies are considered broker-dealers. So brokerage accounts, or what are called retail accounts or non-qualified accounts, those are usually the three terminologies that people use when they are referring to just unqualified, or meaning not tax qualified account. So those ones, the way that they work is it's kind of just the way your checking and savings works. You know, if you have interest that accrues on your checking or savings account, you have to pay taxes on it, right? So same thing with the brokerage accounts. They are or the retail accounts or non-qualified accounts, those are not tax favored. And so when you put money in, when you have gains in there in the form of dividends, interest, or capital gains, then you have to pay taxes on that. So dividends are basically you get paid from the stock company for holding their stock. Interest is just like what it sounds like when you make interest off of, a CD or a bond. And then dividends, I'm sorry, not dividends, capital gains. That's when you go from, so dividend or capital gains are when you've bought something, let's say like a stock, and you bought it for $10 per share. And then it has increased in price to, let's say, $13 per share. That $3 difference is your capital gain. Now, it's only what's called realized. So those capital gains are only realized once you've actually sold the investment. So it's kind of like, again, the house analogy. If you've bought a house, it can increase in price while you're living in it, but you haven't realized any gains because you haven't sold it. Once you've sold the house, then you've realized the gains from the increase in prices from what you bought it at to what you sold it at. So if you bought, let's say, a house at like $250,000, you sold it for $300,000, then that $50,000 is your capital gains. So I hope that makes sense. It's a pretty basic idea. So and we won't go into it in depth in this video, but if we need to, let me know and I'll make another video about that. Anyway, so the capital gains, the interest and dividends that you accrue inside your brokerage account or your retail or non-qualified account, those you have to pay taxes on in the year that you receive those gains. And so that's pretty much it. That's all there is to the brokerage account. Other than that, I mean, you can trade in and out of it as you see fit. You can do, depending on how sophisticated you want the brokerage account to be, you can have margin on there so that you can do short selling if you want to do that, and options. So, and that gets pretty sophisticated. We won't get into that in this video, obviously, but that's just the type of account it is. So it doesn't give you any tax benefit. It doesn't shield you from taxes. You can't deduct anything when you put money into those accounts. You can consider it, like I said, it's basically like a checking savings account that you are allowed to trade investments out of. So basically that's how you can see a brokerage account. So then you've got your traditional IRA and your Roth IRA. So now these are the ones that most people have questions about. Believe it or not, these are actually, the rules on this are pretty simple. And the reason for that is because it ensures the IRS gets every penny that comes out of these accounts or goes into these accounts. The vast majority of American wealth is actually in retirement accounts, whether it's 401ks or IRAs. And so IRS has made these rules very simple to ensure that they get their money. So nice of them. Anyway, so let's get into it. So I've got this to make some, to help you guys understand. I'm going to draw on this, but yeah, I know I should be more tech advanced because I'm Asian. But it's so bad. I'm really like tech challenged to some degree. So I need to get, I guess, software that allows me to show my screen with you guys when I'm recording, but that will come down the road. So, all right, so let's talk about this. We're going old school. We are going to do marker and paper. So, all right, so you can consider the traditional IRA like a box, okay? And, oh, I just am realizing now that I'm looking at this video, it's backwards. I'm gonna have to like write it backwards. Hold on. I was not anticipating that. I was expecting for it to be legible the way I see it. So, okay, this is gonna take a second. So, okay, yay, it worked. Okay, so IRA is like a box. And the Roth, okay, you're gonna have to bear with me because again, I have to write this backwards. Yay, okay. So the Roth is like a triangle. They are two different types of accounts, okay? Although they both have the name IRA in it, which stands for Individual Retirement Account, they are two different types of accounts by IRS code, okay? So this is why they're two different shapes, so that you don't get them confused. So this is a traditional IRA. Maybe I should put that on here. Okay, so traditional IRA and then the Roth IRA. Let me just, there we go. All right, so the way that this works is that when money is going into, we're gonna go with the traditional first because that's the one most people actually hold. So when money goes in, okay, there's no taxes. Okay, let me, there's no taxes that you pay on the way in. But when the money comes out, let's say to like your, let's say your savings account, okay? Did I do it? Oh, yay, okay, I did the S right. Okay, so let's say that the money is going into your savings account. Let me draw that there, okay. Then you have to pay taxes on this. Okay, that's when you get taxed. So there's no taxes on the way in, there's taxes on the way out. So people ask, okay, well, what if you like put money in from your checking savings account that's already been taxed into your IRA? Then what you'll do, and this is the reason why people make contributions into their IRAs come tax season, it's to mitigate some of the tax implication. What I mean by that is any money you put into an IRA, you can deduct off your taxes. So the way the IRS views it is this money goes in to the IRA, even though it comes from your like checking savings account, because they let you deduct that amount off your taxes when you file, then they consider it like it's a wash. It's never been taxed before. So when the money comes out into your checking or savings account for you to use later in retirement, then it's taxed because they give you credit for it here when you made the contribution. So then they basically tax you on the way out. Does that make sense? So I hope it does. So that's how the IRA works. This is why people come, April 15th, people are like madly trying to put contributions into their IRA because it allows that tax deduction off of their income for the year. So currently as it stands, if you are under the age of 50, okay, so 49 and younger, then you're maxed out at $5,500 that you are allowed to contribute into an IRA account, whether it's traditional or Roth. If you are 50 or older, you are allowed a $1,000 catch-up contribution. So you got the $5,500 plus the $1,000, so you have $6,500 that you are able to contribute into your IRA. So, and let me preface this, in no way am I giving any tax advice at all. We're just talking about general rules of IRAs. Far as any, impact on your taxes, personally, you would have to talk with a CPA about that. So again, this is in no way giving you any tax advice. I'm just talking about how IRAs in general work. So, all right. So then the Roth is the opposite of the traditional IRA. So the Roth, you pay taxes as you go in, and then there's no taxes on the way out, okay? So, I don't think I did the no taxes. Oh, did I do that right? Yeah, no, I did it right. Okay, no taxes on the way out. So, so the way that this works is, okay, so the benefit of this is that when you put money in, you were putting more money in because it's not taxed, right? And then the growth from that is supposed to be compounding because there's more money that has gone in pre-tax dollars. And then on the way out, you get taxed on everything. So it's all considered ordinary income. There's no difference between dividends, interest, or capital gains. It all comes out as just ordinary income. So this is, again, that very simple rule that I was talking about that IRS has made to ensure that they capture every penny. This is how they do it. So there's no loopholes here. I mean, people have tried. Again, they made the rules very simplistic to prevent loopholes from happening. So it doesn't matter what the reason is this money comes out, it's a taxable event, period. And they don't care if you're pulling out principal, again, the dividends or interest or capital gains, it does not matter. It's all taxable. Here, any money going in and then is taxed, and then on the way out, there's no taxes. So again, it doesn't matter if there's dividends, capital gains, or interest, or principal, it doesn't matter. None of it gets taxed on the way out. Obviously, the principal has already been taxed, so it doesn't matter. But so that's how the Roth works. So people always ask, the question gets asked quite often, well, Kim, if, you're paying taxes on the way in or on the way out, like what is the benefit? If on the Roth, you're paying taxes on the way in, then, what's the benefit? Or if you're paying, you're not paying taxes on the way in on a traditional, but you're paying taxes on the way out, what's the benefit? So let me tell you the logic of how they had anticipated this to work, and then you can see where the logic comes in or why it's a benefit. So originally, when the IRA and 401ks and the 457s, 403bs, all of those under IRSA, when they were created in 1978, the idea was this. When you are working, you are at a much higher tax bracket, right? Because you have earned income. You have potential for raises and promotions, and you get bigger income. So you're at this higher level, and they're allowing you to stuff all this money away into your traditional accounts, IRAs or 401ks. So we'll just keep with the IRA because we're trying to keep this simple. So they allow you to put all this money away into your traditional IRA account at this higher tax level. And then when you are retired, you should be claiming little to no income, so you should be at a much smaller tax bracket. So that disparity should be your tax savings. And the allowance of putting money in pre-tax dollars compounded with growth should give you a nice bigger return. And again, that kind of enhances the tax benefit that you get from a traditional IRA account, because again, when you're retired, you should be claiming little to no income. So that's the logic behind that. And then the Roth is that you've put all this money in tax-free, or sorry, taxed upfront, and then all the growth on the back end is now tax exempt. So it doesn't matter how high rate your tax rates go. It doesn't matter, what tax bracket you're in. It's all exempt. So that's the idea behind the Roth. Now, the Roth came substantially later. It came in 1998 is when it was first introduced. And now that we have enough data from having the Roth in the economy, what we're seeing is an interesting trend. So again, I'm disclosing this. In no way is this any tax advice for you. You need to talk with your CPA to see if this is beneficial or not. But so what we're seeing, though, in the data is that the idea of the traditional IRA, which is that you have this tax savings because you're in a lower tax bracket when you're, retired, we're seeing that the tax brackets are not as low as they had anticipated. So originally it was, anticipated the tax brackets would be like really, the disparity between the two should be fairly large. But what we're seeing is that it's actually not as large, or in some cases, people are at the exact same tax bracket as they were when they were working. So you might wonder, well, how's that happening? A few things. So, some of the big things that people forget when they are retiring is that they don't have those write-offs. You don't have your mortgage to write off anymore. And so that deduction is gone. And then your kids, which, they might still be living at home with you, but if they're grown up, you don't get to write them off anymore. So that deduction is gone as well. And then, of course, tax rates, they don't ever go down, they go up. So they're finding that the tax benefit out of a traditional IRA is not quite as much as they thought it was originally going to be. They thought it was going to be this big. What we're finding in reality, it's much smaller, if any. So in some cases, and usually this is affecting more really super high income earners, that their tax brackets really don't change much once they retire. And then other lower tax brackets, again, their savings still isn't as big as it was anticipated. So what we're finding now is that the Roth IRA holds quite a bit more tax benefit, especially for people who are in their working years now. And so that's something to consider when you're deciding which account you want to go into, which one you want to open up. Now, these ones, because these are IRAs, you don't have to go just through a brokerage firm to open up these IRAs. You can open these up at your bank or your credit union. Now, if you open up at your bank or credit union, they're going to limit what you can invest into these because they can only do like money market and CDs. But if you go into a brokerage firm, like the ones we discussed before, then you can open these up and you can trade, anything inside of them as you see fit. You can't do options or margin calls or short selling, but you can do traditional stocks and bonds and mutual funds. You can do all those. So you can do those in these two accounts. But yeah, so when you are considering which ones to go into, again, you need to really look at your tax bracket, talk with your CPA, and figure out which one's going to be most advantageous. Although there are benefits to the Roth, there are still benefits to the traditional IRA. If you are already in like a high tax bracket while you're in your working years, this is a good way for you to try to mitigate some of the tax implication. But it comes down to which one do you prefer, if you want bigger tax benefits later or if you want bigger tax benefits now. So that's where you would want to, look into what your tax brackets are, which one's going to be most advantageous to you. Now, I told you that you can also do this with a 401k. So the ideas for a 401k are exactly similar to this. It's just that the 401k is what's called an employer-sponsored account, okay? So it's an employer-sponsored plan. So you can't go to like Fidelity and be like, I want to open up a 401k. No, like that has to be offered by your employer. You can't just go anywhere and open up a 401k. Your employer has to offer it to you. That's why it's called employer sponsored. Now, the basic ideas, as far as the functionality, is very similar to these. And a lot of employers have gone to offering Roth 401ks. So again, they work just like this, just like these two. So a traditional 401k works like a traditional IRA, and a Roth 401k works like a Roth IRA. But the difference is that it's, again, through your employer, and the contribution limits are substantially higher. So here in the traditional IRA and the Roth IRA, combined between these two, you cannot exceed that contribution limit of $5,500 if you're under 50, and you can't exceed over the $6,500 if you're 50 or older. Whereas in a 401k, those rates are substantially higher. For a 401k, it's $18,500 if you're under 50. It's $24,500 if you're 50 or older. So you can see where the benefits would be coming in from, contributing into a 401k as opposed to a Roth. 401k as opposed to an IRA. So whether it's traditional or Roth. So the contribution limits are a lot bigger. But so I hope that helped. Oh, far as knowing if your employer offers, which kind of 401k, you just need to talk with your HR department. It's coming into an open enrollment season, which is perfect that we're talking about this right now. For most companies at least. And so you can go talk with your HR department and just ask, hey, do we offer Roth 401k? If so, again, that's something for you to consider. Consult with your CPA first and see if that's something you want to do. But definitely you want to make sure you are taking advantage of a 401k at your work, especially if they're matching. Now, if they're not matching, if you can put away the high contribution limit, it's still a benefit. If you can't, then, one of these will be just fine. But if you are getting a match of some kind, any kind from your employer, you really need to be participating in the 401k. So this is something that a lot of people, I don't know how, but they don't think about this part when they're thinking about not contributing into their 401k and their employer matches, okay? Something most people don't consider is that when your employer is offering a match into your retirement account, that is considered part of your pay. So when they hired you and calculated what it would cost to hire an employee, they look at all the costs associated with hiring that employee. So the medical benefits, the retirement benefits, their salary, the cost of, the overhead costs. They considered all of this. So if they're giving you a match and you're not taking advantage of the retirement benefits, you're basically telling them, I don't want to get paid. You're leaving money on the table. And so you really want to make sure that, and find out from, again, your HR department, if your company matches. If they do, you really need to be taking advantage of that. That is part of your pay. So don't leave money on the table. Make sure you're taking advantage of it and talking to your HR people and finding this information out. So I hope that helped. I feel like I went through quite a bit already. I don't want to make this like a super long video, but yeah, so this is something that if you guys want to go into further discussion with, we can. Just let me know. Again, if you want to just leave a comment, or if you want to go ahead and send me a message and, to ask questions, that's fine. I'm more than happy to help you wherever I can. So hopefully that gives you some clarification. I want you guys to be familiar with this because I can't tell you how many times I've come across people that were like in their, 50s that, I had literally one client that brought in their 50-year-old son, having me explain this to them because their son had not understood any of this. And although the parents, my clients, which were the parents, they were savers, their son was not. And so I had to try to teach them why this was important. So I don't want you guys to start, too late on saving. I want you guys to start saving now, because the more you save now, the more you'll have for the future. And I feel like our generation needs to make sure that we are taking advantage of this, of all the accounts and tools available to us. So, and that's again part of the reason I'm doing these videos, is so that I can help people. But anyway, so hopefully that helped. And again, if you guys have any questions, let me know. And I will talk with you guys later. All right.